So at this point, since you've probably read the title, you know that Dennis and I have sold off all of our investments in individual stocks. Well, maybe not all of them yet, but we have started to sell them off and plan on getting rid of all of them from our portfolio over the next couple of months. Now, if you've been watching our videos, then you probably aren't surprised because we've been talking about investing in passive ETFs for a while now. But if you're new, you might be wondering why we aren't investing in any single stocks, especially when you think about all the arguments out there and the stories that you hear about investing in single stocks and analyzing what the best ones are. We talk a lot about how our investment strategy has evolved over time as we've learned more, and we're big proponents of getting started now and then growing your confidence over time. Well, for us, when we look back at our money journey, something that we've definitely learned is that you don't know what you don't know, and where you start is probably not going to be where you finish. So let me start off by asking you a question. If you're someone that does invest in single stocks, or if you want to invest in single stocks, how do you know if a company is a good investment? Do you buy companies that you know and you use on the regular? Do you buy companies that you research yourself? Do you buy companies that are recommended by your friends and family? And how do you know when you should be buying or selling these companies? These are some of the questions that we're going to talk about today, but from the perspective of our personal money journeys. So let's go back to the beginning and show you how we got to where we are today. Now, when I first started investing back in 2021, and by the way, right now I'm going to skip past the first couple of years before that when I actually started investing and I had my money in mutual funds, because at the time I literally just walked into the bank and had them set up my investments for me. I had no clue what was going on with them. So instead, I'm going to take you to early 2021 when I decided to actually gain more control over what was happening with my money. So around this time, I had just moved the money that I had invested over to a robo-advisor. Now, my goal at the time was simply to pay less in fees, put my money to work mostly through ETFs, and then also to invest in single stocks on the side, specifically companies that I was interested in or knew something about, either from researching them or from actually buying things from those companies. Now, at the time, this plan sounded great to me because most of my money was being put towards a less risky long-term portfolio, but at the same time, especially since I was new to investing, the idea of actually selecting and investing in single stocks here and there felt more hands-on and honestly sounded fun to me too, and it felt like everyone was doing it, especially at that time. I want to mention that the idea of picking stocks based on companies that you know is something that we hear about all the time. It's also used as a way to get people more interested in investing because it's a pretty easy theory. You just buy what you know. It also instills this sense of confidence in your ability to invest. Basically, if you buy shoes, tech, and coffee at companies like Nike, Apple, and Starbucks, and these companies are a part of your daily life, then you should invest in these companies and own a piece of them and not just buy the products that they sell. Now, is this actually a good theory? We're going to get to that. So back to me. At the time, I purchased shares of some telecom companies that I knew of, some different energy companies, and also from my favorite clothing store, which I might still be wearing a shirt from right now. Still my favorite clothing store. But at the time, I was putting about $1,000 a month towards the ETFs I was buying, and then about $300 a month towards all these different stocks. Now, Dennis was doing a pretty similar thing. He started investing in 2021 as well. He also wanted to pay less in fees. He wanted to invest mostly in passive ETFs and then buy some single stocks on the side too. Now, the difference between us is when it came to Dennis's portfolio, he felt like he needed to have this really elaborate plan. So he would stay up at night reading into all these different companies. He would look at all the different financial statements. He would basically dig into all the different metrics that he possibly could. Now, here are the different stocks that he ended up investing in at the time. Ultimately, we learned over time that there's a lot of research to back up the fact that all the research that you do into these companies, all of that, doesn't mean that you're going to make money by selecting single stocks, which we're going to get more into later.
Now, keep in mind that this time period that Steph's been talking about, so 2021, this was literally like the golden year right after the pandemic, where pretty much every company was benefiting from low interest rates and stimulus money just circulating everywhere. Basically, stocks were up and the markets were just green on top of green. So if you were investing during that time, including investing in single stocks, you were seeing these positive outcomes that honestly just wouldn't be sticking around forever. Now, the human behavior around investing in single stocks is really interesting. We as people literally get a dopamine hit whenever our investments are up. And I mean, like, it can feel really, really exciting. But on the other hand, it can feel really upsetting whenever our investments are down. And guess what? That can majorly impact and affect our decision making. We definitely experienced this ourselves early on. And keep in mind that we were never investing in single stocks with the intention of making a lot of money in the short term. Our plan was always to invest in companies that were going to be good long-term investments. But even with that being said, seeing the ups and downs, I should say, of investing in a single stock kind of gives you those high and low feelings, especially if you're new to investing. Now, on top of those feelings, in general, it can be hard to avoid the temptation to invest in single stocks and even speculate with stocks and even crypto, especially when you're hearing some of these like crazy, wild success stories. Or for anyone who's looking back at the market being like, hey, a few years ago, I bought Apple shares for like $100 a share, and now they're trading at like $200 a share. Imagine if I had just put all of my money into all Apple shares way back when. And what's funny about that is that in hindsight, sure, you could say that about a lot of things. The reality is that yes, sometimes there are positive outcomes that come from stock picking. And of course, there are stocks typically called blue chip stocks that have held up over a long period of time. But in general, the positive outcomes that you see from stock picking should mainly be attributed to luck. It doesn't always feel like it though. We typically have a lot of confirmation bias when the outcome is positive. Basically, if a stock that you own goes up, and you believe that it would go up beforehand, you start to believe that you have a lot more control over the outcome than you really do. Something that we've said before that really rings true here is that passive investments perform better than active investments 90% of the time. And guess what? Stock picking is actively investing. So even if you experience a positive outcome one time or with one stock, when you really look at the big picture of your entire investments and you look at your long-term return, statistically, you're just not gonna do as well as you're hoping you will. And I'm gonna talk more about this in a second, but first, let's get back to us. So when me and Steph first purchased our single stocks, we felt great because we were investing in good companies. And since they were good companies with solid financials and were well established, we felt like they were great investments at the time. What we've learned personally since then is that we aren't looking to maximize our returns in the short term, because in order to do that, you're just taking on a lot of risk. There are literally no investments out there that are gonna give you a 10, 50, or 100% return in the short term without also running the risk of you losing your money by those same percentages, if not more. Instead, we wanna maximize our potential to gain the strongest long-term returns because there are options out there that are much less risky for a solid return, but you just have to have patience.
Basically, what Dennis is saying is that you're not going to beat the market or make thousands or millions of dollars in the short term by investing in passive ETFs. You can in the long term, but not in the next handful of years. Now, this concept can be really hard for people to grasp because who wouldn't want to make money in the short term? And it can make it tempting to want to invest in these single stocks too, because what if you do end up making a lot of money? For us, we learned mostly from doing a lot of research and also from really grasping the fact that we mentioned before about passive investing outperforming active investing the majority of the time, that we wanted to focus on maximizing our long-term returns. By throwing money at a chance to beat the market in the short term, we were taking away from those long-term investments in order to buy those stocks. We want to put everything we can towards the less risky, more likely to lead to a good return approach of passive ETFs, and all equity ETFs specifically, so it's still 100% stocks. That's actually an important thing to touch on. When you invest in funds, you still have exposure to good companies that perform really well. The difference and the benefit is that you're not relying on yourself or anyone else to select one good company among a sea of companies. Instead, you're automatically selecting a good company, although a smaller portion of it within the fund. To give you a quick visualization, let's say that you invest in a good company. If the stock does go up as you expected, then great, you've potentially made a lot of money. But if it doesn't and it unexpectedly drops in value, then you've actually potentially lost a lot of money. And if you're emotional, like a lot of people are, then you might sell and actually lose a lot of money. On the other hand, if you invest in a fund that includes that same company, again, if that stock goes up, then amazing, it's brought the fund up and you've potentially made money again. Just a little bit less than if you went all in on that one company. Now, on the other hand, if it does drop in value instead, it doesn't impact you nearly as negatively because you have all these other companies in the fund to balance it out. So back to our single stock portfolios for a second. Now, by the time we hit like late 2022 or early 2023, a lot of our single stocks were now down. So we were starting to lose money. Again, I'm saying like losing money in quotations because you haven't actually lost money until you sell your investments, but they had dropped down in value. Now, keep in mind that we only had a couple of $1,000s in these accounts specifically. So in the grand scheme of things, it's not like it was that much money. It was like a few $100 put towards each stock. But when you work hard for your money, it doesn't feel good emotionally to feel like you're losing it. Also, another thing to keep in mind is that when we were purchasing shares of these companies, we were thinking of the long term. So we technically shouldn't have cared about any short-term losses. But again, at the time, like we mentioned before, we had started to realize that there were more efficient and less risky ways of investing and constructing our portfolio for the long term. So it was just kind of annoying to see these stocks that we were no longer even interested in buying into moving forward going down in value. value. On top of that, you need to understand who you are as an investor too. It's okay to invest in single stocks if you really want to. Ideally, you'd be selecting specific stocks that are solid long-term choices and not penny stocks, but you don't have to in order to be successful in the long term.
Okay, so here's what our single stock portfolios are looking like right now. So Steph sold off a few of her positions back in December, so Bell Canada, TELUS, and Emera, without any losses. It was actually a pretty simple process, and I'm pretty sure she recorded her screen to show you guys how it went, but basically on Wealthsimple Trade, she just inputted that she wanted to sell off all of her shares, and literally just like that, they were gone, and yeah, that was done. It was pretty simple and straightforward. And what's funny about that is that, buying and selling stocks can sometimes feel really emotional, but the actual process itself actually ends up being pretty simple and straightforward. Anyway, she sold those ones off first, and then over the next couple months, she'll be getting rid of her remaining few, which are Aritzia, Brookfield Renewable, and Algonquin Power. I've actually already sold off like the vast majority of my single stocks, but I still have Algonquin Power remaining, and I plan on getting rid of that one soon as well. For us, it honestly feels relieving to be offloading these single stocks because I feel like one of the most important things when it comes to your own money journey, on top of building your confidence and your knowledge over time, is to be aligned with your long-term vision and your goals. So removing those pieces that aren't really aligned with that long-term plan feels really, really great. For us, the decision to invest only in passive ETFs has eliminated so many other decisions. It's literally almost like choosing simplicity has somehow made our lives easier. But for real though, it's a lot more simpler, and on top of that, it only involves the initial work and research that you need to do in order to, one, decide to actually go with this method, and two, select a platform, an account, and the specific ETFs that you're actually going to be using. Now, on top of it being simpler, the long-term return is statistically going to be higher anyway, so it's a win-win. And now the biggest takeaway that we have is that we feel confident and secure in our plan, and honestly, there isn't a better feeling than that. I also want to make it clear that we're not telling you what you should be doing in this video. We just want to share, as we always do, where we're at within our investing journey and why we've made this choice. It's okay if you want to invest in single stocks, but we're all about setting up a solid long-term investing foundation via passive ETFs and then building from there, optionally if you want to. Anyways, I really hope that you guys enjoyed this video, and make sure you let us know if you're investing in single stocks and why, or in general, what you're investing in right now. And yeah, we'll be back next week with another video as usual.